What'd you get? Oh, okay. This is your. I have your dad's signature.
Hi, I'm Bill Ackman. I'm the CEO of Pershing Square Capital Management, and I'm here today to talk to you about everything you need to know about finance and investing. And I'm going to get it done in an hour, and you'll be ready to go. So let's begin. In order for you to get a better sense of finance and some of the basic terms associated with a business and investing in a business, I'm going to use the example of a lemonade stand. We're going to go into business together. We're going to open up lemonade stands. So the reason why I'm using the example of a lemonade stand is a very simple way to understand the basics of a business, how to understand how a business works, how a business generates profits, what's involved in raising capital to start a company, what you do when you're ready to decide to monetize your investment or take some money off the table. You'll be able to understand each of these concepts through the very simple lens of a small startup business like a lemonade stand. We're going to go into business together. We're going to start a company. We're going to start a lemonade stand. And now I don't have any money today, so I'm going to have to raise money from investors to launch the business. So how am I going to do that? Well, I'm going to form a corporation. It's a little filing that you make with the state, and come up with a name for your business. We'll call it Bill's Lemonade Stand. And we're going to raise money from outside investors. We need a little money to get started. So we're going to start our business with 1,000 shares of stock. We just made up that number. And we're going to sell 500 shares more for $1 each to an investor. The investor is going to put up $500. We're going to put up the name and the idea. We're going to have 1,000 shares. He's going to have 500 shares. He's going to own a third of the business for his $500. So what's our business worth at the start? Well, it's worth $1,500. We have $500 in the bank plus $1,000 because I came up with the idea for the company. Now I need a little more than $500. So what am I going to do? I'm going to borrow some money. I'm going to borrow from a friend, and he's going to lend me $250, and we're going to pay him 10% interest a year for that loan. Now, why do we borrow money instead of just selling more stock? Well, by borrowing money, we keep more of the stock for ourselves, so if the business is successful, we're going to end up with a bigger percentage of the profits. So now we're going to take a look at what the business looks like on a piece of paper. We're going to look at something called a balance sheet. A balance sheet tells you where the company stands, what your assets are, what your liabilities are, and what your net worth or shareholders' equity is. So you take your assets. In this case, we've raised $500. In exchange for the $500, the person who put up the money only got a third of the business. The other 2/3 is owned by us for starting the company. Well, that's $1,000 of goodwill for the business. We'll borrow $250. We're going to owe $250. That's a liability. So we got $500 in cash from selling stock, $250 from raising debt, and we owe $250 loan. And we have a corporation that has, and you'll see on the chart, shareholders' equity of $1,500. So that's our starting point. Now let's keep moving. What do we need to do to start our company? Well, we need a lemonade stand. That's going to cost us about $300. That's called a fixed asset. Unlike lemon or sugar or water, this is something you, like a building, you buy and you build it. It wears out over time, but it's a fixed asset. And then you need some inventory. What do you need to make lemonade? Well, you need sugar, you need water, you need lemons, you need cups, you need little containers, and perhaps some napkins, and you need enough supplies. So let's say I have 50 gallons of lemonade in our start of our business. 50 gallons gets us about 800 cups of lemonade, and we're ready to begin. Let's take a new look at the balance sheet. So now, we spent $500. We only have $250 left in the bank, but our fixed assets are now $300. That's our lemonade stand. Our inventory is $200. Those are the supplies and things, the lemons that we need to make the lemonade. Goodwill hasn't changed at $1,000, so our total assets are $1,750. We still owe $250 to the person who lent us the money. Shareholder equity hasn't changed. We haven't made any money. All we've done is we've taken cash, we've turned it into other assets that we're going to need to succeed in our lemonade stand business. So let's make some assumptions about how the business is going to do over time. We're going to assume we're going to sell 800 cups of lemonade a year. We're going to assume that each cup we can sell for $1, and it's going to cost us about $530 per year to staff our lemonade stand. So now let's take a look at the income statement. So the income statement talks about the profitability, about the revenues that the business generated, what the expenses are, and what's left over for the owner of the company. So we've got one lemonade stand. We're selling 800 cups of lemonade in our stand, charging $1, so we're generating about $800 a year in revenue. And we're spending $200 on inventory. There's a line item here called COGS. That stands for cost of goods sold. We have depreciation because our lemonade stand gets a bit beat up over time and it wears out over 5 years, so it depreciates over 5 years. We've got our labor expense for people to actually pour the lemonade and collect the cash from customers. When we have a profit, we have an EBIT, and that's earnings before interest and taxes of $10. It's kind of our pre-tax profit for the business. We didn't make very much money because you take that pre-tax profit of $10 and you compare it to our revenues, it's about a 1.3% margin. That's not a particularly high profit. Now we've got to pay interest on our debts, and we have a loss of $15, and then we don't have any taxes, but at the end of the day, we still lose money. Should we continue to invest in the business? We've lost money in the first year. Is it time to give up? Let's think about it. Let's make some projections about what the company's going to look like over the next several years. Let's assume that we take all the cash the business generates and we're going to use it to buy more lemonade stands so we can grow. Let's assume we're not going to take any money out of the company. We're not going to pay a dividend. We're going to keep all the money in the company and reinvest it. As we build our brand, we can charge a little more each year. So we're going to raise our prices about a nickel, 5 cents more for each cup of lemonade each year. And then we're going to assume we can sell 5% more cups per stand per year. So we've got a built-in growth assumption. Well, let's take a look at the company. Take a look at this chart. You'll see in year one, we start out with one lemonade stand. We add one a year, and then by year 5, we're up to 7. We've got a big expansion. Our price per cup goes up a nickel a year, and our revenue goes from $800 and starts to grow fairly quickly. Growth comes from increased prices for cups of lemonade, and it also comes from opening more stands. So by year 5, we have almost $8,000 in revenue. Our costs are relatively constant, which is lemonade and sugar. That's about $1,702. We have depreciation as the more and more stands start to wear out over time. We've got labor expense. But by year 5, the business is actually doing pretty well. We went from a 1.3% margin to over a 28% margin. The business is now at the scale we're starting to cover some of our costs. We're growing. We're still paying $25 a year in interest for our loan. We have earnings before taxes after interest of $2,300 by the end of year 5. So we put $500 into the business, we borrow $250, and by year 5, we're making a profit of $2,300. That sounds pretty good. Now we have to pay taxes to the government. It's about 35%. We'll generate net income, or another word for profits, of $1,500 by the 5th year, and about $100 a share. Think about this. Our friend put up $500 to buy 500 shares of stock and paid $1. And after 5 years, if our business goes as we expect, he's actually making $1 a share of profit. That sounds like a pretty good deal. Let's look at the cash flow statement. So as the business becomes more and more profitable, we generate more and more cash. And the cash builds up in the company. We go from $500 in cash in the company to over $2,000 in cash over a period. The balance sheet. Again, the starting balance sheet had shareholders' equity of $1,490. That's more profitable. The profits add to the cash, they add to the assets of the company, our liabilities have not changed. The business continues to build value over time. So again, by the end of year 5, we've got $4,000 of shareholder equity, and that's almost 3 times what it was when we started. Now, is this a good business or a bad business? How do we think about whether it's good or bad? One thing to think about is, what kind of earnings are we achieving compared to how much money went into the company? This is a business that we valued at $1,500 when we started. So we put up $500 for a third of the company. We gave it a $1,500 value. At the end of year 5, it's earning over $1,500 in earnings. So that's over 100% return on the money that we put into the company. That's actually quite a high number. We spent $2,100 in capital building lemonade stands. We earned $2,336 in year 5 on the capital invested. It's over 100% return on capital. That's a very attractive return. Earnings have grown at a very rapid rate, 155% per annum. It's really a growth company. And our profitability has gone from 1.3% to 28.6%. Year 5. That sounds pretty attractive, and it is. So let's look at first we put up a loan. Our business paid $250, and the business has been profitable. We've been able to pay them their interest of 10% a year, $25 a year. And they're happy because they put up $250. They're getting a 10% return on the loan, and the business is worth well more than $250. We've got more than that in cash. As a result, they're in a safe position. But they've only made 10% of their money. Now let's compare that with the equity investor, the person who bought the stock in the company. That person earned $1 a share in year 5 versus an investment of $1 a share. So he's earning over 100%, or about 100% return on the investment, versus only 10% for the lender. So who got the better deal? Well, obviously the equity investor. Now, why the equity investor? Why do they have the right to earn so much more than the lender? The answer is they took more risk. If the business failed, the lender is entitled to the first $250 of value that comes from liquidating the company. If you sell off lemonade stands and you only get $250, the lender gets back all the money. You're safe. They got their 10% return while the business was going. They got back their $250. The equity investor, the person who bought the stock, is wiped out. They come after the lender. So what's the difference between debt and equity? Debt tends to be a safer investment because we have a senior claim on the assets of the company. And it comes in lots of different forms. You've heard of mortgage debt on a home. That's a secured loan secured by a house, but you can have mortgage debt on a building or a company. There's senior debt, there's junior debt, there's mezzanine debt, there's convertible debt. Bottom line, it's all debt. It comes in different orders of priority in a company. And the rate you charge is inversely related to your security. So the better the security and the less risk, the lower the interest rate you're entitled to receive. The more junior the loan, the higher the interest rate you're entitled to receive. But you can avoid the complexity. All you need to think about is debt comes first. It's a safer loan, but your profit opportunity is limited. Now the equity, also they're varying forms. There's something called preferred equity or preferred stock. There's common equity or common stock. And again, stock and equity are basically synonyms. They're options, but really not worth talking about today. The important point is that equity gets everything that's left over after the debt's paid off. So it's called a residual claim. Now the good thing about the residual claim is that the business grows in value. You don't owe your lenders anymore, but all that value goes to the stockholder. So the question is, why was the lender willing to take only a 10% return when the equity earned a much higher rate of return? And the answer is, when the business started, there was no way of knowing whether it would be successful or not. And the lender made a bet that if the business failed, well, they could sell it to a lemonade stand. It cost $300 to make it. They would have some lemons, some lemonade. Even if they sold at a much lower price than the dollar they originally projected, the lender felt pretty comfortable that they'd get their money back. Whereas the stockholder was really taking a risk. They were betting on the profitability of the company. They were taking a risk that if it failed, they would lose their entire investment. So they were entitled to get a higher return, or have the potential to have a higher return in the event the business was successful. So let's talk about risk. A lot of people talk about risk in the stock market as the risk of stock prices moving up and down every day. We don't think that's the risk that you should be focused on. The risk you should be focused on is when you invest in a business, what are the chances that you're going to lose your money? There's going to be a permanent loss. When you're thinking about investing your own money, you're thinking about one investment versus another, don't worry so much about whether the price moves up and down a lot in the short term. What matters is, ultimately, you get your money back and you earn a return on your investment. How do you think about risk? Well, one way to think about risk is to compare your risk to other alternatives. So you can buy government bonds. And government bonds are considered today the lowest risk form of investment. And the U.S. Treasury issues 10-year, 3-year, 5-year debt. There's a stated interest rate, and today a 10-year Treasury, you earn about a 3% return. So you give your government $1,000, you get $30 in interest. At the end of 10 years, you get your $1,000 back. So that's very, very safe, and that sort of provides a floor. Now, obviously, if you're going to make a loan, you can lend money to the government and earn 3%. Well, if you can lend money to a lemonade stand, you want to earn meaningfully more. So in this case, lender is charging a 10% rate of interest. Why 10%? Because they want to earn a nice fat spread over what they can make lending to the government. As a startup lemonade stand business is a higher risk business. Equity investors sort of think about things similarly. So the higher the valuation, the more risky the business, the higher the rate of return the equity investor is going to expect. And the lower the risk business, the lower the return the equity investor is going to expect. And equity investors don't get interest the same way a lender does. What equity investors get is the potential to receive dividends over the life of the company. Let's talk about raising capital. You started this lemonade business. The point of this was to make money in the first place. Business is doing very well, yet as having started the business, coming up with a name and a concept, hired all the people, I've made nothing, right? So the business has grown in value, but where's my money? I need money to buy a car, for example. So I want to buy a car for $4,000. What are my choices? What can I do? Well, we've taken all the cash the business has generated, we've reinvested in the business. Now the good news is, we've taken all that money, we've been able to use it to buy more lemonade stands, and these lemonade stands are more and more productive, and it's growing the value of the business faster and faster. Now my alternatives could include, well, instead of growing the business so quickly, instead of investing in more lemonade stands, I could simply pay dividends to myself. Now the good news about that is I get money along the way. The bad news about that is the business wouldn't grow as quickly. When the business is profitable as this lemonade stand company, and we can earn hundreds of dollars in each new stand, it makes sense to keep investing. Well, how do I keep my business going and growing, taking advantage of the opportunities, but take some money off the table? How do I do that? I sell my lemonade stand business. I started this one in New York. Maybe there's someone in New Jersey who wants to buy me, consolidate my lemonade stand company. The problem with that is once I sell it, I can no longer participate in the opportunity going forward. I believe in this business. I think it's going to be very successful over time. So that's one alternative. The other alternatives, other than selling 100% of the business, is to sell a piece of the business. And I can do that privately. I can find an investor who wants to buy a private interest in the company. And if the business is worth enough, I can sell them a piece of the business and it can be successful. The other alternative is I can take the business public. An IPO, the abbreviation stands for Initial Public Offering. And it's initial because it's the first time the company's going public. Going public means you're selling stock to the broad general public as opposed to finding one investor buying interest in the company. And it's an offering because you're offering people the opportunity to participate. What's interesting is an IPO doesn't make someone rich. All it really does is it takes a business that they already own and it sells a piece of it to the public and it gets listed on an exchange. When you decide you want to take your business public, you're going to have to reveal a lot of information to the public in order to attract investors to participate. And the Securities and Exchange Commission, they're going to study this prospectus very carefully. They're going to make sure that you disclose all the various risks associated with investing in the company. And you're also going to have an opportunity to talk about the business. That's kind of an exciting time for you because when you sell shares to the public, that's really, in most cases, the way to get an optimally high price for the company. But you don't have to sell 100% of the business to the public. In fact, typically you only sell a small percentage. You get to keep the rest. You get to keep control of the company. But you get to raise money in the offering, and you can use that money to buy the car that we were talking about before. Now, before you decide to go public, or even to sell it at all, probably a good idea to figure out what the business is worth. So let's talk about valuation, or how to value a business. One way to think about the value of your business is to compare it to other similar businesses. Now, the stock market is actually a pretty interesting place to look. The stock market is a list of companies that have sold shares to the public. And you can look in the New York Times or the Wall Street Journal, or online on Yahoo Finance or Google or other sites, and look at stock prices for Coke, McDonald's. And what those stock prices tell you is what the value of the company is. How do you figure out the value of the company? Well, you look at where the stock price is. You count how many shares are outstanding. The shares outstanding will be listed in various filings with the SEC. You multiply the shares outstanding times the stock price. That tells you the price you're paying for the company. So we go back to our example of our little lemonade stand. We had 1,500 shares of stock outstanding. We sold them for $1 initially, one-third of them to a investor, and the business initially had a value of $1,500. So what is the business worth today? Well, one way to look at it, let's look at other lemonade stand companies. Let's assume other lemonade stand companies have sold either in the private market, the public market, or a price of 10 times earnings or 10 times profits. That will give you a sense of value. So let's assume another lemonade stand company is trading at 20 times earnings in the stock market. Well, we earned $1 per share in year 5. We put 20 multiple on that dollar. The business is worth, according to the comparable, about $20 per share. We've got 1,500 shares outstanding. We multiply 1,500 times 20. Now our business is worth $30,000. We had a company that started at 1,500. 5 years later, it's worth $30,000. That's actually quite good. Well, how do we raise $4,000 if that's the appropriate value for our business? Well, if we sold 200 of our shares, 200 of our shares that are today now worth $20 a share, we could raise the $4,000 that we are talking about. Now, what would that do? What would happen if we sold 200 of our shares in the market? Well, our interest in the business would go down. Right today we own 66 2/3%, or 2/3 of the company. A third is owned by our private investor. Well, if we sold stock in the market, if we sold 200 of the shares that we would own, our ownership would go from 67% to 53%. The good news there is we still have control of the business, because most public companies owning a majority allows you to control the business going forward. But because the company is now owned by public shareholders, you have to make sure their interests are properly represented. We have a board of directors, a group of individuals who represent the interests of the shareholders, who have a duty to make sure that their shareholders are treated properly. And you wouldn't have the same degree of flexibility you had when you were a private company, because you have other constituencies that you need to do. Now, the benefit of the IPO is the stock would now be liquid. There would be a market where it would trade in public markets, and then over time, if I wanted to sell more stock, I could do so, or if new investors wanted to come in, they could buy stock, and our stock would now be liquid. To make me feel better about this business in terms of my ability to, at some point, exit, or if I wanted to raise more money, I could sell stock fairly easily in the market, because each day you could look up the price, either on the web or on a New York Times or otherwise, and you can figure out what your business is worth. Okay, now, how does this matter to you? Now, the purpose of the example of our lemonade stand is just going to give you a primer on what companies are, what they do, how they earn profits, what the various reports they provide to investors, so investors can figure out what they're worth. And the purpose of this lecture is to give you a sense of some of the things you need to think about when you're thinking about investing perhaps some of your own money, whether you want to invest in a lemonade stand or you want to invest in a company on the market. Let's assume at 22 you got a pretty good job. Instead of spending your money on gadgets or a fancy party, not so fancy apartment, going out and drinking for a night, you put some money aside, you start investing money. Let's say you could save $10,000 at 22, and you could earn a 10% return on that money between now and the time you retire. What would you have in 43 years? The answer is you put aside $10,000, you don't save another penny, and you invested it and you earn 10% of your money each year. You'd have $600,000 in year 43. And the reason for that is, well, in year 1, your $10,000 would become 11. In year 2, your $11,000 would grow by 10%. And so you'd be earning interest not just on your original principal, but you'd earn interest on the interest you'd earned in the previous year. And that compound effect allows money to grow in an almost exponential fashion. Now, obviously, if you earn more than 10%, you can earn even higher returns. Now, that's if you put $10,000 aside in 22, have $600,000 in 43 years. That's pretty good. What if you had to wait until you were 32? The problem there is, at year 33, you only have $232,000. Maybe that's not enough to retire. So the key thing here is, if you're going to be an investor, it's really one of the most valuable assets you have today is someone who's 18 or 19 years old at your youth. You want to start early so that your money can grow over time. Now, what if you could earn 15%? Give you a better sense of how powerful compounding is. Remember, at 10% for 43 years, you'd have $600,000. That's pretty good. If you earn 15%, you'd have over $4 million. Now you're in a pretty good position. And so obviously, making smart decisions about where you put your money has a huge difference in what your retirement assets are. Now, obviously, if you put aside more than $10,000, if you put aside $10,000 each year, then your wealth would be quite enormous. Now, just for fun, if you were one of the world's great investors, Warren Buffett being a good example, if you could earn 20% per year for 43 years, you'd have $25 million. And the original $10,000 investment would increase by 2,500 times over time, just by earning a 20% return. Albert Einstein said the most powerful force in the universe is compound interest. So the key is start early, earn an attractive return, and avoid losing money, and you're going to have a very nice return. Okay. Now let's talk about the risk of losing money. Now let's assume that in order to try to get a 20% return, you took a lot of risk, and it turns out that every 12 years, you lost half your money because you hit a bad patch in the market and you made dumb decisions. Well, your $25 million at 20% would now only be worth $1.8 million in 43 years. So a key success factor here is not just shooting for the fences, trying to get the highest return, it's avoiding significant losses over the period. Okay, so as Warren Buffett says, rule number one in investing is never lose money. Rule number two is never forget rule number one. So if you can avoid losses and earn an attractive return over time, you're going to have a lot of money in it if you can stick at it for a long period of time. Okay, so how do you be a successful investor? Now, I'm assuming that you're not going to go into the business of investing. I'm assuming that you're going to be a doctor or a lawyer, you're going to pursue your passion. You're going to have some money that you're going to save over time. And I'm going to give you my advice on the topic. It's not necessarily definitive advice, but it's what the advice I would give my sister, grandmother, on what she should do if she were in the same position. I think that's probably the right way to think about it. So, number one, how do you avoid losing money? What are good places to invest? Well, my first piece of advice is, despite the story about the lemonade stand, I'd avoid investing in lemonade stands. I'd avoid investing in startup businesses where the prospects are not very well known. Because again, you don't need to make 100% a year to have a fortune. You just need to invest at an attractive return, 10, 15% over a long period of time. Your money grows very significantly. So how do you avoid the riskiest investments? My advice would be to invest in public securities, invest in listed companies that trade on the stock market. Why? Because those businesses tend to be more established. You have to meet certain hurdles before they go public. The stocks are liquid, so you can change your mind if you want to sell. If you invest in a private lemonade stand, it's hard to find someone to take you out of that investment unless that business becomes fabulously profitable. So that's piece of advice number one. Invest in public companies. Number two, you want to invest in businesses that you can understand. What I mean by that is there are lots of businesses that you come and you deal with in the course of your day and your personal life, whether it's a retail store that you know because you like shopping there, or it's a product, your iPad, or that you know you think is a great product. But you have to understand how the company makes money. The business is just too complicated. You don't understand how they make money. Even if they've had a great track record, I would avoid it. A lot of people thought Enron was an incredible business because it appeared to have a good track record, but very few people understood how they made money. It was good to avoid it. Another very important criteria is you want to invest at a reasonable price. It could be a fabulous business that's done very well over a long period of time. If you pay too much for it, you're not going to earn a very good return. The last bit is that you want to invest in a business that you could theoretically own forever. If the stock market were to close for 10 years, you wouldn't be unhappy. What do I mean by that? Again, if you're going to compound your money at a 10 or 15% return over a 43-year period of time, you really want a business that you can own forever. You don't want to constantly have to be shifting from one business to the next. And what are businesses that you can own forever? The very few that sort of meet that standard. Maybe a good example is Coca-Cola. Right? What's good about Coca-Cola is it's a relatively easy business to understand. You understand how Coke makes money. Right? They sell a formula syrup to bottlers and to retail establishments, and they make a profit every time they serve a Coca-Cola. People are going to drink a lot of Coca-Cola for a very long period of time. The world's population is growing. They sell in almost every country in the world. And each year people drink a little bit more Coca-Cola. So it's a pretty easy business to understand. It's also a business that is unlikely to be competed away as a result of technology or some other new product. Right? It's been around long enough. People are used to the taste. Parents give it to their children and expect them to be around for a long period of time. I think that's one good example. Another good example might be McDonald's. You may not love McDonald's hamburgers. It's a business that's been around for 50 years. You understand how they make money. They open up build these little boxes. They rent them to the franchisees. They charge them royalties in exchange for the name. And they sell hamburgers and French fries. And you know what people have to eat? It's relatively low-cost food. The quality is pretty good, and they continue to grow every year. So I think the consistent message here is try to find a business that you can understand, that's not particularly complicated, that has a successful long-term track record, makes an attractive profit, and can grow over time. So what are the key things to look for in a business, as I say, that lasts forever? We want a business that sells a product or a service that people need and that is somewhat unique, and they have a loyalty to this particular brand or product, and that people are willing to pay a premium for that. Another good example might be a candy business. While people are willing to buy generic versions of many kind of food products, flour or sugar, they don't need to have the branded product. When it comes to candy, people don't tend to like the Walmart version or the Kmart version. They want the Hershey chocolate bar or the Cadbury chocolate bar or the See's candy. They want the brand, and they're willing to pay a premium for that. And so that's, I think, a key thing. You want a product to be unique. You don't want it to be a commodity that everyone else can sell. Because when you sell a commodity, anyone can sell it, and they can sell it at a better price, and it's very hard to make a profit doing that. If you're investing for the long term, you want to invest in businesses that have very little debt. In our little example before, we talked about our lemonade stand. There's $250 worth of debt. I didn't put too much pressure on the lemonade stand company, but if it had been $1,000, we had a rough patch. The business could have gone out of business for failure to pay its debts. The shareholders could have been wiped out. So if you can find a company that can earn attractive profits, doesn't have a lot of debt, they generate vastly more profits than they need to pay the interest on their debt, that's a safe place to put your money over a long period of time. You want businesses that have what people call barriers to entry. You want a business where it's hard for someone tomorrow to set up a new company to compete with you and put you out of business. I mean, like going back to the Coca-Cola example. Coca-Cola has such a strong market presence. And people have come to expect when they go to a restaurant, they can ask for a Coke and get a Coke. It's very hard for someone else to bring it in. Of course, there's Pepsi and other soda brands. Pepsi's been around a long time. Coca-Cola and Pepsi continue to exist side by side over a long period of time. So when you're thinking about choosing a company, make sure that they sell a product or a service. It's hard for someone else to make a better one that you'll switch to tomorrow. You also want businesses that are not really sensitive to outside factors, so-called extrinsic factors that you can't control. So if a business will be affected dramatically if the price of a particular commodity goes up, or if interest rates move up and down, or if currency prices change, you want a company that's fairly immune to what's going on in the world. I'll use my Coca-Cola example. I mean, if you think about Coca-Cola, it's a product that's been around probably 120 years. Over that period of time, there have been multiple world wars, development of nuclear weapons, all kinds of unfortunate events and tragedies and so on and so forth. But each year, the company pretty much makes a little bit more money than made before, and they're going to be around. You can be confident based on the history that this is a business that's going to be around almost regardless of whether interest rates are at 14%, whether the US dollar is not worth very much, or the price of gold's up or down. Those are the kind of companies you want to invest in the long term. Businesses that are extremely immune to the events that are going on in the world. Another criteria, back to the lemonade stand company, as we grew, we had to buy more and more lemonade stands. Those lemonade stands only cost $300 each. But imagine a business where every time you grew, you had to build a new factory to produce more and more product. And those factories were really expensive. Well, that company might generate a lot of cash in the business, but in order to grow, you're going to have to just reinvest more and more cash into the business. The best businesses are the ones where they don't require a lot of capital to be reinvested in the company. They generate lots of cash that you can use to pay dividends to your shareholders, or you can invest in new high return projects. I guess the last point I would make is that you can invest in public companies. It's probably safest to invest in businesses that are not controlled. Controlled companies kind of like a lemonade stand business. The problem with a controlled company, unless the controlling shareholder is someone you really trust, unless there's someone that has a great track record of taking care of so-called minority investors, the non-controlled shareholders, it can be a risky proposition to invest in because you're at the whim of the controlled shareholder. And even if the controlling shareholder today is someone you feel comfortable with, there's no assurance that in the future they might sell control to someone else who's not going to be as supportive of the shareholder of the business. So it's not that you can simply have a profitable business, a business that has done well. You have to make sure that the management and the people who control the business think about you as an owner and can protect your interests. So these are some of the key criteria to think about. Now, when are you ready to start investing money? My guess is you're a student, you probably have student loans, after you have some credit card debt, you graduate, you get a job. So you don't want to jump right in and while you have a lot of debt outstanding, start investing in the stock market. The stock market is a place to invest when you have money you can put away and you won't need for 5 years, maybe 10 years. So if you're paying relatively high interest rates on your credit cards, you definitely want to pay off your credit cards first before you think about investing in the stock market. Your student loans are probably lower cost than your credit card. But again, here, my best advice would be, if your student loans are costing you 6 or 7%, or if you pay them off, it's as if you earned a guaranteed 6 or 7% return. And you're just better off getting rid of your credit card debt and even your student loan debt before you commit a lot of material amount of money to the stock market. Even once you've paid off your credit card debt, perhaps you've paid down your student loans, you want to have enough money in the bank so that even if you were to lose your job tomorrow, you've got a good 6 months, maybe even 12 months of money set aside. Let's talk a little bit about the psychology of investing. So we talk about some of the technical factors, how to think about what a business is worth. You want to buy a business at a reasonable price. You want to buy a business that's going to exist forever, that has barriers to entry, where it's going to be difficult for people to compete with you. But all of those things are important, and a lot of investors follow those principles. The problem is that when they put them into practice, and there's a panic in the world, the stock market's heading down every day, and they're watching the value of their IRA or their investment account decline, the natural tendency is sort of to do the opposite of what makes sense. To be a successful investor, you have to be able to avoid the natural human tendencies to follow the herd. The stock market's going down every day, your natural tendency is to want to sell. The stock market's actually going up every day, your natural tendency is to want to buy. So in bubbles, you probably should be a seller. In busts, you should probably be a buyer. You have to have that kind of a discipline. You have to have a stomach to withstand the volatility of the stock market. The key way to have a stomach to withstand the volatility of the stock market is to secure yourself. You've got to feel comfortable that you've got enough money in the bank. You don't need what you have invested unless for many years. That's a key factor. Number two, you have to recognize that the stock market in the short term is what we call a voting machine. It really represents the whims of people in the short term. Stock prices are affected by many things, by events going on in the world that really have nothing to do with the value of certain companies that you invest in. So you got to just accept the fact that what you own can go down meaningfully in value after you buy it. That doesn't necessarily mean you made an investment mistake. It's the nature of the volatility of the stock market. How do you get comfortable? Don't just buy a stock, just like the name of the company. Do your own research, get a good understanding of the business, make sure it's a business that you understand, make sure that the price you're paying is reasonable relative to the earnings. Let's say this is just not for you. I don't want to buy individual stocks. It just seems too risky. I don't have the time to do my own research. What are your alternatives? Your alternatives are to outsource your investing to others. You can hire a money manager, or you can hire a group of money managers. There are a couple of different alternatives for a startup investor. The most common alternative are mutual fund companies. What is a mutual fund? A mutual fund is I guess technically it's a corporation, where you buy stock in this corporation, and the manager selects a portfolio of stocks. So what they do is they pull together capital, money from large investors, say they raise $1 billion, and they take that money and invest in diversified collection of securities. Well, the benefit of this approach is that with a tiny amount of money, even less than $1,000, you can buy into a diversified portfolio managed by a professional manager who's compensated to do a good job for investing in the So mutual funds are a good potential area for investment. The problem is there are probably 7,000, 8,000, even 10,000 different mutual funds, and some are fantastic and some are not. You need to do research to find a good mutual fund manager in the same way that you need to find individual stocks. So it's not just an easy thing of just investing in mutual funds. So here are a few key success factors in identifying a mutual fund or a money manager of any kind to select. Number one, you want someone who has an investment strategy that makes sense to you. You understand what they do and how they do it. They're not appealing to your insecurity by using complicated words and expressions that you don't understand. If they can't explain to you in 2 minutes what they do and how they do it and why it makes sense, then it's a strategy you shouldn't invest in. Number two, this is not necessarily in this order, this probably should be number one, is you want someone with a reputation for integrity. Again, if you're starting out, you probably want to invest in some of a mutual fund that's sponsored by some larger mutual fund complexes as opposed to a tiny little mutual fund that's privately by a mutual fund company you've never heard of. There's some benefit in the larger institutions. You'll be more confident that they're not going to steal your money. You want someone, an approach where the investor invests money on the basis of value. Now, this sounds kind of obvious, but value investing has a very long-term track record. Now, there are other kinds of investing, including technical investing, where people are betting on stocks based on price movements, but I highly recommend against this type of investing. You want to make investing by buying companies based on their belief that the prospects of the business are good and the price paid worth represents a significant discount. You want to invest with someone that has long-term track record, and I would say 5 years is the absolute minimum. Ideally, you want someone who's got 10, 15, 20 years of experience investing in the market, because there's a lot that you can learn being a long-term investor in the market. You want someone who has a consistent approach, where they haven't changed what they do materially year by year. They have a stated strategy that they've kept through thick and thin that's enabled them to earn an attractive return over their lifetime as an investor. And I want to say, in some ways, most importantly, you want someone who's investing the substantial majority of their own money alongside yours. You want someone whose interests are aligned with yours. If it's a mutual fund, you want them to have a lot of money in a mutual fund. If it's a hedge fund, which is a privately sold fund for investors who have higher net worths, you want some managers investing alongside you as well. We started with a little lemonade stand company. The purpose of that was to give you some of the basics on how to think about a business, where the profits come from, what revenues are, what expenses are, what a balance sheet is, what the income statement is, how to think about what a business is worth, how to think about what the difference between a good business is versus a bad business, how debt is generally lower risk, lower return, how equity investors or investors who buy the stock or the ownership of a business have the potential to earn more or lose more. We use that just as the basics to get some of the vocabulary to think about investing. We talked about investing in the stock market. We talked about ways to think about how to select investments, how to deal with some of the psychological issues of investing. We covered a fair amount of ground in a relatively short period of time. I entitled the lecture, Everything You Need to Know About Finance and Investing in Less Than an Hour. Well, it really isn't everything you need to know. It's really just an introduction. And hopefully, I didn't mislead you by inducing you to watch this for an hour. There's a lot more that can be learned. There's wonderful books that teach you. I think what's interesting about investing, whether you choose this as a full-time career or not, if you're going to be successful in your career, you're going to make some money. And how you invest that money can make a big difference in the quality of life that you have, or perhaps that your children have, or the kind of house you're able to buy, or the retirement that you're going to be able to enjoy. We talked about the difference between a 10% return and a 15 and 20% return over a very long lifetime, what impact it has in terms of how much wealth you create over the period. So investing is really important to you, whether you like it or not. And learning more about
kill your body. Oh, for goodness sake.
money is something.
This is okay.
I got interested when I was probably 22 or 23 and started interested in being an investor. And I read a book. I read called The Intelligent Investor, written by Ben Graham. And Ben Graham is a famous value investor. And it's kind of like reading Jean-Paul Sartre's You read it, and either it's an epiphany and affects the way you live your life, or it's something that affects you. And this was the equivalent of investing. I found it fascinating. And what I like about investing is it's something very accessible to someone who's 22 or 23. I'm intrigued is that one of the few jobs where every day you can study something new. You're constantly learning about new businesses, new situations, new management teams, new issues. So it's infinitely challenging. The world and the stock market are obviously very dynamic places, so the challenges continue. These same concepts, while they're useful in deciding how to invest your portfolio, are also very useful to you in thinking about decisions like buying a home, making decisions in your line of work, whether to hire additional people. These kinds of calculations and thought processes are helpful, and they're helpful in life. I recommend that you learn more. Thank you for paying attention, and I wish you well.
Warren Buffett needs little introduction. He's the godfather of modern-day investing. For nearly 50 years, Buffett has run Berkshire Hathaway, which owns over 60 companies like Geico and Dairy Queen, plus minority stakes in Apple, Coca-Cola, and many others. His $82.5 billion fortune makes him the third richest person in the world, and he's vowed to give nearly all of it away. The Oracle of Omaha is here to talk about what shaped his investment strategy and how to master today's market. I'm Andy Serwin. Welcome to a special edition of Influencers from Omaha, Nebraska. It's my pleasure to welcome Berkshire Hathaway CEO Warren Buffett. Warren, welcome.
Thanks for coming.
So let's start off and talk about the economy a little bit. And obviously, we've been on a good long run here.
A very long run.
And does that surprise you? And what would be the signs that you would look for to see that things were winding down?
Well, I look at a lot of figures just in connection with our businesses. I like to get numbers, so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses. And it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses. What those numbers tell me, they're interesting, but they're not guidance to me. If we buy a business from all over, we're going to have good years, bad years, in between years, maybe disasters or some year. We care a lot about the price. We do not care about the next 12 months.
But are you surprised at how long this economy has been expanding?
I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read talk about negative interest rates for long periods of time. Go back and read Keynes, read Samuelson, read any of them. They do not get into the negative rate environment. I think now there's still $11 trillion of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen, at least the conventional wisdom on a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about individual businesses we'll do over time, and we compare that to what we have to pay for. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic even if the price went down.
All right, so you don't pay much attention to the dismal scientists then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But and I just don't know any economist that actually has bought businesses successfully or done well in stock. Paul Samuelson did. You may know he was a big shareholder of Berkshire. But it's, they make guesses, and there's so many variables. I mean, in the hard sciences, you know that if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is, you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to make sure you got a good business. But you wouldn't say I'm going to buy it because growth issues, maybe 3% instead of 2.8% or something the same.
Fair enough. You have over $100 million in cash.
Berkshire does it.
Berkshire. No, I'm not sure how much. Maybe you do. Berkshire has over $100 million in cash, and you say that you always want this company to be a fortress. So, how much cash should an ordinary investor have?
It depends on the personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you've got a portfolio of decent diversified businesses, you don't need any cash.
So more cash free than Berkshire is.
Yeah, I've got responsibility. We've got insurance claims. We could have hurricanes that would happen. All kinds of things. We might have to pay out billions of dollars. We've got over 1 million people that own shares of the company. Run the place so we get through periods like that. But if I were retired, I have say $1 million portfolio of stocks that would pay me $30,000 a year in dividends or something. This sort of thing. Make sure the house was paid off and everything. I wouldn't worry too much about having a lot of cash for me.
Let's talk a little bit about Apple. Everyone always wants to talk about Apple. It's kind of its stock, its company. You have a $45 billion stake, more or less. How closely do you follow the company? People are concerned they haven't really introduced any new products.
Well, if you have to closely follow the company, you shouldn't know.
Really?
No, if you buy a business, you buy a farm. You go up and look, every couple of weeks to see how far the corn is up, and don't worry too much about whether somebody says this is going to be a year of gold prices because exports are being affected or anything like that. You buy a farm. You hold it for. I've got one farm that I bought in 1983. That's how many runs. I put that once. It doesn't grow faster if I go and stare at it. I can't cheer for it. More effort or something like that. And I know there's going to be some years when prices are going to be good and some when prices aren't going to be good. Yields will be better than others. But about the farm. It just doesn't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops. And I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn. Now in a good year, it'd be 200. You really make progress. That's one reason commodity prices go back a couple hundred years. They've moved so little. Whether it's cotton or whether it's all kinds of things. And you and I have benefited from that.
And so Apple is kind of a farm.
Well, it's a long-term investment. And if you own the best auto dealership in town, the best brand, and you had you would drop by every day and say, how many people come in today. I think interest rates are going up a little, maybe slow down the sales. They buy it knowing it's 365 days a year. You can own it for 20 years, so that's 7,300 days. And things are going to be different from day to day in your deal. You shouldn't buy it up to day to day.
Let's switch over to talk about buybacks, which is another hot topic these days. And you did a fair amount. If you look at the annual report, you can see that between December 13th and 24th, it looks like you guys bought back about $233 million worth of Berkshire, which was right near that particular stock market. And how did you know that?
Well,
what was going through your mind?
If I knew it, I'd have bought on Twitter. That's not a big purchase for us, actually. Now we will buy Berkshire when we have lots of excess cash, all paid to the business. We spent $14 billion on property, land, way more than 3 years ago. We take care of the needs and we have excess cash. And if we find invest, we'd love to do is find other businesses. But if our stock, if I think the stock, my partner Charlie, I think the stock is selling below intrinsic business value, we will buy the stock.
So it obviously wasn't that quick.
Well, we thought so, yeah. But you know, what's really intriguing is when it goes down a lot. I mean, when you're buying dollar bills for 60 or 70 cents, which periodically you get a chance to do in stocks, and you know, soon you got the cash, you know, whenever some surprise could really take you out. But if we've got excess cash, we'll buy it as fast as we can.
At that point, it would be more like a 2009 rather than just
Yeah.
December.
Yeah,
This
yeah,
massive
yeah.
difference.
But it's, you know, if you and I own a McDonald's franchise together and it's worth $1 million and you own 50% of it, you come to me and say, I'm going to go $100,000. I'd buy you out. So but you want 600,000 all of a sudden, you can turn back around.
So, just continuing about buybacks, Senator Schumer's and Sanders want the government to weigh in to sort of legislate when companies can do buybacks. And then also there was a report recently about executives doing insider trading, it appears, around the time of buybacks. So, are buybacks a big problem?
Well, you'll have some people that misbehave with respect to any action. So that really wouldn't have much to do with buybacks. I think buybacks, you really wish they've been part of nefarious activity. A lot of years are very close to where that's maybe where the but that article did not, I didn't follow it. I mean, you're distributing money to shareholders, essentially, you buy dividends, you American business, distribute money to its owners occasionally, and we do it through buybacks. We do some, and we don't do it. For the most part, we do it through buybacks. On the needs of the business, I think if their stock is underpriced, then it makes nothing but sense.
Should the government tell companies when to do it, or at least mandate conditions where they can?
Well, they do restrict you a little in terms of if you're some general rule of the SEC, if you're having some kind of, this isn't quite the right word, but manipulative activity, you have to stop the health. I don't think the government should decide to dividend policy. I don't even think they should direct your capital investments. They can make it enticing enough for capital investment, which they do with renewable energy, for example. I mean, the government has interest in fostering certain developments in this country over time. And they do create special oil depletion, 50 years ago and so on. That was no politics, it was governmental policy, but certainly renewables are a prime example of that. But the idea of directing whether you are entitled to return cash to shareholders as a matter of skill for your process.
The 2020 election is going to be on us before, and I know that he has some nice things to say about Mike Bloomberg, but it appears he's not going to be.
It's hard to wonder just from what you vote.
That's fine.
But I admire the normal guy.
President Trump is a business executive, so two questions. Is the business executive the right kind of person to be president? And what characteristics do you look for a president to support?
Well, I think a business executive can be the right. I don't think that because of number one, I want a president who realizes the greatest threat to a country which has got all kinds of things going for it. People, organizations, countries could have people that will wipe out a lot. something is the crazy reasons somebody that thinks it's great to send a false alarm to the Russian and the U.S. that the other side is launching. It's a very, very dangerous world. It's a wonderful world, but it has dangers now. It started in August of 1945 in a sense, and it just changes everything in the world. It's a permanent thing. So I want a president that has that same filter. All of these other things are important, but protecting the country and reducing the chance of successful use of weapons of mass destruction against us is the number one job. And I think most of the presidents, I've talked to a couple of them over the years, I really think that they do realize it. They may get lost in the events of every day as they go home. And then beyond that, I want a president that has two objectives with the economy. One is to make sure that this marvelous goose we have keeps laying more golden eggs. And then I want a president that also feels that the GDP of $60,000 per capita in the United States, that nobody should get left behind. We've got a market system that works marvelously in turning out more goods and services, better ones, year after year, done it all through my life.
Would you ever talk to a candidate and say, hey, what do you think about these three things?
Well, they'll tell me what I want to hear. I want to hear what they tell people who disagree with them on the subject. I always like to ask a candidate, they usually finesse me some way or another, but I say, what are you for that the majority of your followers are against? You know, I know you really believe in that. You know, and that's really the test, but I'm not sure that, except under some kind of sodium pentothal, great answer.
That's great, but that's the question you ask the presidential candidates or presidents that we speak to.
If I really want to get, and that's why Bernie Sanders was so successful. I mean, 90% of the people who voted for Bernie Sanders had probably not heard of him 2 years earlier. But they felt that they knew exactly what he would do. I mean, they felt he was authentic. And if you asked him, you know, what he was for that most people might be against, he would tell you it. You know.
A few questions about Kraft Heinz. Was that a mistake?
Well, we'll find out over time. But we did pay too much, in my view, for Kraft. We didn't pay too much for Heinz. So when we started out, it was originally a non-public partnership between us. And we did pay too much, in my view, for Kraft. And there's not much you can do about things if you pay too much. Secondly, there's always been a struggle between the retailer and brands. I mean, if I've got a terribly weak brand and I want to get into Walmart, I'm not going to be able to do it. I'm going for all kinds of crazy concessions. And I want to be in Walmart if I have some sort of super packaged goods. The negotiation is way different. You have something essential versus non-essential. 10 years ago, Costco tried to get rid of Coca-Cola. Costco's got terrific loyalty customers. Their own Kirkland brand is a $39 billion brand now. It moves from category to category. It only started in 1992. So they know brands. But in the end, they put Coca-Cola back in. If it had been Royal Crown Cola, they wouldn't have had to put it back in. So there's always that struggle between the brands, and there always will be. But the retailers net has been moving in their direction, particularly, I think, because of the Amazon revolution.
First Walmart.
Walmart, yeah. But it's been accentuated. I think we have a new retailing environment now. I mean, it isn't like it goes from night to day, but it moves somewhere. And brands and people spend billions of dollars sponsoring TV shows, sponsoring radio shows. Campbell Soup was always on there with Jack Benny or something, you know, when I was a kid, and it was big. And it built brands. and people obviously like the product too, but people are more willing to change, and it's harder. It's a somewhat different world. It is night and day. I mean, you are very unlikely to keep changing brands every day. But it really surprised me that Gillette lost position. I mean, men don't like to experiment much. Women are better experimenting, but you know, if a kid, when you were a kid, if Gillette Cavalcade of Sports was your pal and brought you the Rose Bowl and the World Series and all that sort of thing, you just shave the Gillette the rest of your life, and you still do to a great degree, but it's not exactly the same as it was even 5 years ago or so.
You mentioned Amazon as a game changer, and I have to ask you haven't bought the stock. You're an admirer of Jeff Bezos. A listing of the richest people in America came out. He's number one. I think your friend Bill Gates is number two. You're number three. So you can see what he's done in myriad ways. And of course, the question is, how come you haven't bought Amazon? Is there still time to buy? Would you still buy?
Oh, I always admired Jeff. I mean, I met him 20 years ago or so. And I thought he was something special, but I didn't realize you could go this much. I mean, he had a vision and executed it in an incredible way. Something that it was not a, you know, but there's a lot of games like that. I would have missed Microsoft even if I gotten to know Bill earlier. I mean, those just aren't my games. I don't worry about the things I miss that are outside my circle of competence of evaluating. I have missed things that were within my circle, and that's a terrible mistake. Those are my biggest mistakes. You haven't seen them. But I don't, it's not a mistake because I miss Netscape or something like that at all. I would say that maybe 5% of the companies or 10% of the companies at most are within an area of my circle of competence. That's something I should be able to understand.
All right, well, let me switch gears then and ask you about leverage a little bit. And corporate debt, people are concerned about. People are concerned about federal debt at $22 trillion. Should we reduce, let's just say, the federal debt, and how would we do that?
Well, if you're running a deficit getting close to 5%, when things are really good, you know, that's a new world. And neither the Republicans or Democrats are particularly concerned about it. And we're not having a lot of inflation. That wasn't supposed to happen, you know. It's happening. That's why I say you don't want to get hung up on trying to make economic analysis, because you know, nobody's any good at it. You don't get rich doing that. If you look at, you mentioned that Forbes list, if you get on the list, the number of people that have done that by economic analysis, I think about results.
Okay, fair enough. Income inequality, wealth inequality, you've talked about the earned income tax credit. Is there more to it than that? Should we adjust tax policy? It seems to be going the other way right now.
Well, it is going the other way, but I think the earned income tax credit is the best way to put money in the pockets of people that don't fit well into the market system, but that are perfectly decent citizens and that have made a good bit of the success of something like I've had with Berkshire or something possible. It wouldn't have happened without the America we have. And if you go back 200 years, and we're all working on, 80% of us are working on farms. The person that's the best at that, working on that farm, whatever it may be, is worth maybe twice the ones that's the worst. I mean, that's the difference between super talent and no talent in a farm economy, picking cotton or whatever it may be. Now, if you're the best middleweight fighter in the world, you may get $20 or $30 million. And if you are just a good citizen, raise nice kids, help in the neighborhood and everything else, but you don't have market-related skills, you'd be good on that farm still. And you would be earning something comparable to most of the people around you. But you don't have something now that as it gets more and more specialized, and it's going to continue to get more specialized. You want two things for that person. You want them to have a decent life. I mean, they live in a country with 60,000 GDP per person. You want them to have a decent life, and they can. I also think you want them to have a feeling of accomplishment. So you want them to have a job, assuming that they're not handicapped in some way. You want them to have a job. But the minimum wage would be one way, say, well, we'll make sure that they have enough money in their pocket. But that's got a lot of effects in disturbing the market system. They just need more cash. They don't need a higher wage. They need more cash in their pocket. And the government, at relatively low cost, can provide a decent living for anybody that's working 40 hours a week and has a couple of children. And we've gone in that direction, and it's sort of bipartisan. Both Republicans and Democrats. I think it would be better not to have one annual payment, I think there are various things you do, but you want them to feel part of the system, and you want to have them get as more and more of these whole things relate. You want to get a little more of this.
And if we don't do that, and the Democrats win, it's possible we get, big taxes on wealthy people, free college for all, and those are bigger plans.
You want more money in the pockets. Everybody's willing to work, or is unable to work. And we can do it. A rich family would do that. I had 6 or 7 kids, and I had some business I wanted to pass on. You pick the most able person or money, because that's the market system to do that. But you make sure that all 7 of the family participated. You give more to the one that, you might give more to the one that kept producing the golden eggs. You would. But you wouldn't just say to the one at the lowest end, who might be the best kid of all in most respects, he's the one that shares with everybody and there's all kinds of and you wouldn't say to that him or her that, too bad, that's just the way the market system works, go have your spouse get a job and look for housing someplace.
Right. Why don't we do an update about the healthcare initiative, which now the company has a name.
Yeah,
Haven. Was that your idea?
No.
Sometimes
I didn't worry about a name. We could have gone on as a no-name operation for 10 years. No, that is, we got a wonderful partnership in the sense that it's large and has reasonable market muscle with more than 1 million employees. We've got 3 CEOs that can make things get done in organizations that are so big that normally they would get very bureaucratic. I mean, if you try to do this with many big companies, you'd have legal weighing in and public relations weighing in. We don't have any of that stuff. They may have them in certain areas, but I don't have to. But Jamie isn't going to worry about doing that sort of thing at Needham Jet. So we've got a unity of commitment and an ability to execute on the commitment. The only problem is you've got a $3.4 trillion industry, which is as much as the federal government produces every year. Basically, feels pretty good about the system. As we went around talking to people, find a leader for the group, for example, everybody says, the system, it turns out very good medicine, but you can't go from 5% of GDP to 18, without really making you less competitive in one other thing in the world. So everybody thought the system needed some adjustment, just not they're part of the system, and that's very human. I do the same thing, I'm sure, if I was in the same place. So there's an enormous resistance to change, while a similar acknowledgement that change will be needed. And of course, if the private sector doesn't supply them over a period of time, people will say, we give up, we've got to turn this over to government, which will probably be even worse.
How often do you talk to Jamie and Jeff about it? I know Todd Combs, I think, is reporting.
Todd really does all the work at ARPA. If this works, give Todd 100% of credit from the Berkshire standpoint.
Does Haven have to buy companies to gain expertise? What do you?
No, I don't.
What is the plan?
The plan is to support a very, very, very good thinker on this subject who is a practicing physician and who commands the respect of the medical community to, in effect, figure out some way so that we can deliver even better care and have people feel better about their care too. I mean, they have perceived they're receiving better care over time, and stop the march upward cost relative to the country's output. We've got this incredible economic machine, but we shouldn't be spending 18% when other countries are doing something pretty high in terms of doctors per capita, hospital beds per capita. The very top stuff in medicine, I think, is very much concentrated in this country, and that's great. I want us to be the leader, but I just don't. I think we're paying the price. If we're paying 7 extra points of GDP, that's $1.4 trillion a year.
Is the administration focusing, by focusing on drug prices, is that sort of a rabbit hole? Is that missing the bigger
I don't.
picture?
I mean, they're trying, and Congress generally. I mean, you talk to the average congressman, they regard it as a problem, and they see specific instances, of drug prices or something like that. But it's a big problem to change. I mean, the problem is it intersects in so many ways, and that's why we've got Kawani heading it. We've got 3 besides organizations backing it. We're not trying to really make money. I mean, that is not a goal.
The Brian is on the phone.
To make money off of.
Won't he be talking about health insurance?
Well, we'll be one to everybody. His game plan is not something we're going to try and lay out because it's in his head to some degree. I mean, obviously, we selected it by hearing him and reading him and so on, what he's done. But he'll learn as we go. We will conduct certain experiments, or he will, and try out a community where one of us has a lot of it. There's various ways to experiment.
Shifting gears, where do you find things like that Abe Lincoln tail and leg quotes? When you read Bartlett's book of quotations,
No, I don't. But probably 50 years ago, I looked at a few Bartlett's quotations, but I read a lot.
You just remember these things and apply
Well,
them?
if you're 88 years old, you don't know what happened yesterday, but you remember the old stuff. You've got a lot of interest in quotations in your
That's right. Okay. So one company you invested in is GE.
Yeah.
And you did well with that investment.
Yeah, I was too early, actually. If you look back, I was very active in the last half of September and early October, and then I wrote that article in later October. And I knew it was going to get bad. I wrote the article was going to get bad, but I didn't think the stock market would react as much as it did between then and March. So I had more or less used up our powder well before the bottom was hit.
That's interesting. How have you avoided not getting back into GE more recently? I mean, I'm sure that they've reached out to you. Everyone says, why doesn't Warren Buffett invest in GE and save it and take it to the promised land? It's this great American company.
Well, actually, I think Larry actually is doing a good job.
Larry Culp.
The Danaher, yeah, Larry Culp. The Danaher is a good show. And I think his priorities are straight, and I think he's very able and he's on the right track. And I'm a fan of GE in the sense that we're a big buyer from them, we're a big seller to them, knowing the managers. I mean, Jack Welch is a very good friend of mine. Politics 100%, but we have a lot of fun together. So I've got a great desire for GE to do well. It just hasn't looked that attractive to me.
You talked about the groves of trees in the letter to shareholders. One was the third grove, which was sort of the in-between states.
Yeah, the equity interest.
Yeah. Is it the case that those are sort of not the healthiest grove of trees? And why would that be?
No, those are the pilot flying fish, they're companies that under GAAP accounting, we have to record under an equity method. We own more than 20%, but we don't control them. And so it's treated under GAAP accounting as a special category, and it didn't fit well in the other grove, so I had to make it a separate grove by itself. It's not that significant.
You say that the sum of Berkshire has a greater valuation than the parts.
That is true.
Did you ever try to calculate that? How much is that?
Well, it depends on circumstances. I mean, there's sometimes when the float insurance can be very valuable. There's sometimes when the ability to use production tax credits, let's say in the utility business, but have them on our as part of our consolidated return helps. But that varies a lot. But it is a plus. We can move capital. Well, take a business like See's Candy, which we bought 40 odd years ago. It's a wonderful little business. It throws out capital. We try 50 different ways to expand geographically, do all kinds of things. Doesn't work. And we'll try it again, and it won't work. But we can move that capital help buy the NSF Railroad or do all kinds of other things. So we've got a seamless and tax efficient way of moving capital where it's needed. And we've got some companies that really chew up capital and big others that kick it off. And we can move it to one pot. If you try to do that with your investments, there's some taxes as you go along doing it. It's less efficient than what we've done.
You talked a lot about the tax cuts and the benefits to Berkshire. You didn't really get into the costs of the tax cut, which surprised me a little bit. What are there costs? I mean, is it just free money?
Well, it makes a difference. The tax cut we get, for example, our utilities, as I mentioned in the report, that goes to the customers. It's just the nature of the utility regulations. But net, we're a significant beneficiary. Of the tax cut. I mean, basically, let's just say we had one price of stock. You and I own a business together, and we think we own all the stock, but we prefer the tax cut. The government had a 35% share of the stock on income. It didn't have a share of the assets, but it had a share of the income. And if it wanted to change it to 40, it could have changed it. Unfortunately, it changed it to 21. And we have private business. We have a model franchise. The third shareholder, that invisible shareholder, the government, just handed us back most of the shares of stock. And our shareholders benefited from a lot of the shareholders.
You talked about Ajit Jain and Greg Abel saying that Berkshire blood flows through the veins. Have they made a difference since they've become vice chairs? And are they like Warren and Charlie?
No, they don't have the interaction. They each run a separate business. Ajit does not think about the other businesses, even about the insurance business, and Greg does not think about the insurance business at all. I think about the money and the capital and so on. But they run two very big businesses. I mean, Ajit's business, has all told at least a couple $100 billion of assets, and Greg's business has $150 billion of revenues. I mean, these are both up toward the top 10 or so in the country in terms of value. So, the top 15. They're very big businesses.
But they're not exactly like you two guys.
No. Charlie and I have a partnership thinking about the whole place, and we've done it forever, and we still do.
And Todd and Ted? I didn't see them mentioned.
Well, they have $13 billion each, including pension funds that our pension funds that they run, and so the $173 billion we had at year end in equities, they had we had 173, but we had another $8 billion in pension funds. So the 180 or so, they have 26 between them that they're managing. They got total discretion on that. They don't ask me. At the month end, I look and see what they did. They don't do much. They don't do a lot of trading or anything. But I look to see what changes they made. And Todd, for example, I mean, he made a couple of small investments in private placement type operations, and I know what the business is doing.
Was one of those advanced investment Oracle and you sold it? Was that something they did?
No, that was something I did.
Yeah, and you said you didn't understand it. That's why you sold it. Then why'd you get it in the first place?
Yeah, well, That's a good question for which I do not have a good answer. I see about, I know enough about the club to know I don't know enough about the club.
Right. Okay. So Barclays put out a note. They said they were lowering the estimates for Berkshire for EPS. Do you read that stuff?
No. Well, I may read it accidentally, but I don't seek it out to read. I'll put it that way. But it just doesn't make any difference. You know, because if I spent time reading that, I wouldn't have the time to read 10Ks. And we're not going to do anything different. I don't know. As I put in the annual report, I really think this is unique. We do not prepare financial statements monthly for Berkshire. And there's just no other company that does it. There's no sense to it. I know where the money is. I know how the companies are doing generally, but what difference does it make? Because I'm not going to try and hit any numbers for a quarter by, having a sale on insurance or doing something even worse. And Charlie, he knows where we stand. And you know what businesses are doing well, which aren't. I certainly know where the money is.
Another one, UBS survey of Berkshire investors says the 5 most important things to them are succession, investment performance, M&A opportunities, share repurchase, insurance margins. Do you read that? Or is that
no, but I don't disagree with that. I mean, I'm glad that somebody understands this.
Your own investors.
Yeah. Well, that's important. 54, well, you go back to when I started my partnership in 1956, that Berkshire came out of it. There were 7 people sitting there at a table, having dinner, relatives primarily. And I said, here's the partnership agreement. It's done under Nebraska law. It's 4 or 5 pages. You don't need to read it. And then I said, here's a little half-page, what I call the ground rules. And I want you to read these. And if you feel okay about that, about the interaction, what the expectations are, and all of that sort of thing, then we'll join forces. And if you don't, it's fine. Other people have it. No. But we should be partners. I mean, if I'm going to have a partnership with someone, probably is there. When you have a public company, you can't control them. I can't control some guy in a company that thinks we're going to get So by my actions and my communications and everything, I want to attract the people that from the public market that I want. And I want people that there's a way possible was built. Solid Larson set the price point. He sat down and figured out a customer didn't want. And he set up a system that was the way the customer didn't want. He did not want to go to somebody buying a quart milk. There's somebody behind him with a basket of $200 was waiting for that. So we put in a membership fee, and by putting in a membership fee, he killed all the drop-in business that belonged to the 7-Eleven. We want Berkshire to keep out people who have expectations about us that are different than ours. I mean, good for them, and I hope they find somebody they fit. But if you're going to run a church, you want your seats to be filled by people that are generally want to listen to your form of religion. And you don't want to change every week and say, gee, I need a new group, and I'll go out and talk to a bunch of investors and get that to come to my church this Sunday. There's only so many seats in the church. I think 645,000 or so equivalent shares, and those are the seats. And I want them occupied by people that are on the same page I am.
Church of Berkshire. Seems like you've got a big weighting in financials. And of course, you're only investing in Jane Addams' company. Why banks are
They're businesses I understand, and I like the questions. There's something about their future prospects. I think 10 years from now, they'll be worth more money, and I feel there's a very high probability on that. And I don't think they will turn out to be the best investments at all. The whole kind of thing you could do, but I'm pretty sure that they won't disappoint me.
Is climate change changing your insurance businesses?
No, it doesn't change the insurance business.
Does it change modeling or something in the business?
No, it would change our insurance business when we were writing 20-year policies. I mean, there was something that changed life mortality adversely to the interest of life.
What's sparking back in your face?
For now, we're okay.
It's adverse to me. That's what's happened in long-term care insurance right now. But when you write a policy country 1 year at a time, see what the developments are. You know, cars, for example, are much safer to drive than they used to be. There used to be 15 deaths per 100 million miles driven. Now there's a little over 1. On the other hand, they've become much more expensive to fix. You know, those little side right and center view mirror almost cost $10, you know, now $1,000 or something like that. So you have things that are changing, and you're writing collision experience insurance. You got to allow for the fact that the windshield, the bumper, all kinds of things, the side view mirror, way down. But if you're writing liability, you know, people aren't going to die as often. So climate change is like it. Climate's been changing, but the truth is that you now can buy really big catastrophe limits.
Do you want the
Buy out.
We've got.
5 or thereabouts, allowing for
I don't really someone think
$10
Well, even the
So far, rates have come down. I think we've gotten out of the cap. We were very big writers about 10 or 12 years ago. We aren't out of the cap because of climate change. We're out because the prices aren't right. And the world will change. And it's got very serious consequences.
yeah, that's
Change
please.
years.
If you have smaller boats, that can fit.
You talked about technology making us faster than our ability to understand it. And I'm wondering if social media, Facebook and Google and Russian trolls coming in, is that maybe an example of that? Or are you still worried about that problem?
Well, I think cyber.
Ladies, thanks for coming to visit your old uncle. So I look like, do we look alike?
Yeah, we do. The
Railroad.
glowing things, Astro, nothing can do about it. Since where it
We have
is.
to carry it. We have no choice.
Right, this thing is empty now. One of you needs to carry it. Nothing
I
else.
would rather. We've been better about a cyber world than a cyber world.
Are you getting the
All
boss?
kinds of. The problem about something like cyber is it's moving and it's just unpredictable whether it's going to some crazy guy like the anthrax. You know what they can do becomes magnified. You saw what 19 guys did. You know, 9/11. I mean, tools into the hands of either crazy individuals, crazy groups, or even a few crazy governments, you know, are really something. And we don't necessarily know what all the tools they have are, and that is moving all the time. I mean, you know, again, Einstein said, I know not with what weapons World War III will be fought, but World War IV will be fought with sticks and stones. You know, I mean, it's a dangerous world.
I don't know if you've been following this, Warren, but what do you think of Elon Musk's behavior as a CEO?
Well, I think it has room for improvement. Now, and he would say the same thing. It's just some people have a talent for interesting quotes, and others have a little bit more of a blocker up there. That's the problem. But he's a remarkable guy. But I just don't see the necessity to communicate. You know, I think I've got 7 tweets because a friend of mine signed me up for it. She's called me about 100 times saying, can I tweet this or that? And I said yes to her 7 times, I guess, or something like that. I've never actually written one myself. I don't even know how to do it.
Have you talked to Elon ever?
He joined the Giving Pledge, so once or twice, but that's a lot of years ago. 7 or 8 years ago. I'm not. He hasn't come to our annual gathering, so I haven't seen him in 7 or 8 years.
So let's talk about this trade war that's been going on a little bit with China. And I guess I'd like to ask you, do you think that Donald Trump was right in calling out the Chinese government and basically putting them on notice?
I won't have any comment on that. In terms of political activity, I don't put my citizenship in a blind trust. So when the election comes around, I'll do something. On the other hand, people will interpret things I say about any president, as to some extent coming from Berkshire, and they don't come from Berkshire. Obviously, so I think I'm glad to talk about China, but I can't talk to you about that part of it.
Fair enough. I mean, do you think there was room for improvement then in terms of the trade relationship between China and the United States?
Well, I think that China and the United States absolutely destined to be superpowers, beyond my great-grandchildren's lives, and will always be competitors, and will be competitors in business, will be competitors in ideas, all kinds of ways. And there's no other way it would be. And we just have to make sure that competition doesn't get us to a point where we don't realize that the best world is one in which both the United States and China prosper. We do not want to have an island of prosperity in the rest of the world, envious of us in a nuclear age. And China doesn't, Russia doesn't. I mean, we all recognize the dangers of letting competition get out of control and become, we can be competitors without being enemies. And that's what all powerful nations have to realize over time. I mean, it's different than 200 years ago. We could have some dominant country, and then they may have done some things that you didn't like, but it didn't threaten the existence of the world. It really threatened the existence of the world, as we know it, if important countries do not constantly recognize that they can compete, they can fight over certain things, but they can't regard it as essentially the equivalent of war.
Here's a question from Kevin Chen, who is a Berkshire shareholder and NYU professor. And he says, and this is sort of along the lines of what you were just saying more, but do you think that U.S. and China will be able to resolve their differences, or are conflicts unavoidable?
Well, I don't think conflicts are unavoidable, but I think it has to be active thinking on the part of countries, hugely powerful countries, and Russia's hugely powerful. 90% of the nuclear arms in the world are between U.S. and Russia. They have to recognize that the best world for them is one where they don't have all the apples, and we have to recognize that. And we can't, in the United States, we can't think that either our ideas run the world, or we start getting aggressive about things, and China can't think that, and Russia can't think that. And that's obvious. You just have to make things, you have to be sure things don't escalate. World War I, with an archduke, I mean, you get chance incidents, and you really want to, I asked one of the presidents one time, what he would do if awakened in the middle of the night with somebody coming to him and saying, absolutely. They also launched, would you launch on that? And we got 10 minutes to decide. I wouldn't want to have that as a possibility, but you want to make sure you don't get to that point.
Right. Would you ever make a big acquisition in China? And if not, aren't you missing a huge portion of
Yeah, the answer is we would. Yeah, we would.
Have you looked?
We made aware of it.
Are you concerned, on the whole side of the point, are you concerned that the rule of law is different, that the accounting might be opaque?
Well, I'd want to be sure I understood the accounting. Obviously, some businesses that'd be easier to do than others, but I know the laws, the customs, the accounting, the people better in the United States than anyplace else. So there's some small hurdle in many countries to get over, which I can get over. I mean, but I just don't it's just not as easy as looking at something where I already know the answer from previous transactions or something of the sort. So it's easier to make a big acquisition in the United States. I have to do more work if I look beyond the borders. But I love the idea of doing it. When we made the acquisition in Israel a dozen years ago, I didn't know what the tax rates were there. I didn't know what corporate law. I suspected that it would all be answered satisfactorily, which it was, but I didn't just automatically know it.
It seems like you're more open about doing a deal in China than previous conversations.
I don't think so.
It's out there.
I'm open. Yeah, we made two decent-sized stock acquisitions that worked out fine.
Those are?
Well, PetroChina and BYD.
BYD, yes.
Yeah, BYD was Charlie's, but Charlie's very well versed in China.
The trade, the U.S. trade deficit has been widening, and of course a lot of that has to do with our trade with China. Is that something that worries you?
Well, I wrote an article about it for Fortune and the trade situation many years ago, and when our deficit got to be large in relation to GDP. I don't think it's essential to have a trade balance, but I think that if the trade deficit gets large and it looks like we have no way out from it, that can be a real problem over time. I mean, you're shipping little pieces of paper to the rest of the world, and they're shipping new goods. I mean, people are working, making underwear or shoes someplace, and they get little pieces of paper from us. And it gets very tempting if you've done that enough to make sure that those little pieces of paper aren't worth very much over time when they want to cash them for something. So you don't want to have any problem with trade deficits, but and really larger, and we sort of worked ourselves into a box where they didn't really have a solution to get the numbers down. It could be a problem, and I wrote about it all the time. It's kind of a nice thing, actually. Wouldn't you like to have something where you just have little pieces of paper and somebody keep supplying you with your food or your...
I'm living it.
You're all, right. Yeah, right, exactly. And we call them credit cards in the United States.
Exactly, yes. Okay, and last question. China is facing its slowest growth in nearly 3 decades, and leadership there lowered the targets, I think, to around 6.5%, 6%. Are you concerned about this slowing growth and the impact on global markets?
Well, I don't worry about global markets. I mean, China's going to grow a lot. When you think of what's happened, this is 1949 or whatever, but there's been nothing really like it. We had 20% of the world population at that time. It really hadn't remotely achieve their potential. They had intellectual capacity, they had decent soil, all kinds of things. I mean, and what's happened there almost is beyond belief. And that game's not over, but we've had incredible outcomes in the United States. Real GDP per capita is 6 times what it was the day I was born in the United States. 6 times. And we thought we were a pretty strong country then. No, my parents wouldn't have believed it. I mean, they would have thought, this kid has really got it made. Being born in the United States, and it was true. I mean, we had this tailwind, and China's had a hurricane behind it, in recent decades.
In a good way.
Absolutely.
Because you were comparing with the tailwind, hurricane at your back.
At their back, and they have found a way of life that is dramatically different than existed for the billion. And they have changed. The size is, I don't think there's ever been anything like it. They've done it too, but it took so much longer. I mean, it was more stretched out. It was a remarkable period, but when you go to first went there in 1995, and then they regarded it as a miracle. And then I went back 10 years later, and it was a whole different country beyond that.
Warren Buffett, thanks so much for joining us. I'm Andy Serwer. You've been watching Influencers. We'll see you next time. When Warren Buffett, the Oracle of Omaha, speaks, investors from around the world listen. After building Berkshire Hathaway into one of the world's largest companies, Buffett amassed a fortune of more than $70 billion, placing him among the richest people on the planet, promising to give away nearly all of his wealth to those in need. Now, in these difficult times, we turn to this stock market sage for his financial wisdom and calm. In this episode of Influencers, I sit down with Warren Buffett as we discuss the markets and the pandemic that has brought the global economy to a near halt. Hello everyone, I'm Andy Serwer. Welcome to Influencers and welcome to our very special guest, Warren Buffett, Chairman and CEO of Berkshire Hathaway. Warren, nice to see you.
Good to see you.
So it's March 10th and it's the day after the stock market crashed. The Dow was down over 2,000 points. Oil cratered to $30 a barrel or so. The 10-year bond went to below 0.5%. What the heck is going on, Buffett?
I told you many years ago, if you stick around long enough, you'll see everything in markets. And it may have taken me to 89 years of age to throw this one into the experience. But, you know, markets, if you have to be open second by second, they react reasonably. And it's not like market for real estate or farms or, you know, things of that sort.
Does this remind you of any other time?
Well, I've certainly been a fair number of times when panic has reigned in Wall Street. And October 1987, and the period around it, I mean, there was panic at the close of business on Monday, October 19th. Most of the specialist firms, which were important in those days on the New York Stock Exchange, were broke. And the next morning, there was a check due to the clearinghouse in Chicago that didn't get there. And sometime late in the morning, you know, a decision, I think Palin had made a decision, you know, we're going to stay open, but it was really close. That was, and of course, the financial panic. There were, you had 35 million people on September 1st that weren't worried at all about their money market accounts. On September 15th or 16th, they were all.
How concerned are you about the coronavirus situation, Warren?
Well, you got to defer to the doctors on that, but you know, you get into all these figures about how flu regularly kills, you know, 20 times as many people in this country as, or 40 times as many people seen the way it does, more than that. But you know, it is a pandemic. It is, so we got something. We don't know how long it'll be with us. We don't know how severe it'll be. But there will be uncertainty about that for a considerable period of time.
What precautions are you taking personally? Are you changing your habits?
Well, I'm drinking a little more Coca-Cola, actually. That seems to have warded off everything else in life. I mean, I'm 89. I just had, you know, 2 different doctors tell me I'm in much better shape than I was a few years ago. I'm not sure what I'm doing to get in better shape. But by accident, I had the annual heart check where I wear something around my waist for a couple of guys, and it's never been better. So, no, I really, I'm a probabilities guy in my nature. So it'll be 2.8 million deaths this year, and at age 89, I'm a little more likely to be than I was in that. But 2 million, you know, yeah, so far. It will grow, but I've always felt a pandemic will happen sometime. I mean, I've actually used that term. I mean, in describing things it can interrupt the progress of not only this country, but the world. It won't stop the progress of the country and the world. I mean, this is this is a terrible event that's occurring. We don't know how terrible it may not turn out to be that big a deal. When we get through, but it may turn out to be a very big deal. We just don't know. And I certainly don't know. And nobody knows. But there will be other things that happen in the world in the next 5, 10 years. That's the way the world works. It's not a completely, of course. The progress of mankind is incredible. And that won't stop. Throughout it, you flew over a country that 250 years ago, there wasn't anything here. That's only 3 of my lifetimes, and there wasn't anything here. And now you've got all these bountiful farms, and you've got 260 million vehicles in the country. They've got 80 million owner-occupied homes, and you've got 155 million or whatever it is, million people working. And I mean, it's incredible. I had a medical check the other day. I went to medical facilities that were just 200 minutes from here, and I wasn't here. Being here 100 years ago. So we keep making progress. We haven't forgotten how to make progress in this country, and we haven't lost interest in making all kinds of people around the world. But there will be interruptions. And I don't know when they will occur, and I don't know how deep they will occur. I do know they will occur from time to time, but I also know that we'll come out better on the other end.
And then what about the banks? And boy, they have been hit awfully hard because of rates and exposure to the energy sector, right?
Yeah, and you don't know what other exposure there is. I mean, the credit standards have been pretty darn good, and the quality of what's on the books is terrific on liquidity and all of that. The banks are in a whole different situation than was during the 10 or 20 years ago. But you don't know the nominal is the topple.
You can find information and make a payment on our interactive website, www.oilbridge.gov.uk. Alternatively, please hold. We will answer your call as soon as possible.
So
Please
there's
note,
ripple
calls may be
effects.
recorded for training and security purposes.
There always will be in recessions. That's the nature of recessions, as you get ripple effects. We get ripple effects on the railroad. There's less intermodal traffic moving now because of supply chain and but that's, again, I mean, in 1942 when I bought my first stock, the Philippines were about to fall. I mean, and the day I bought it, the Dow literally was down 2%, and 2% then was only 2 points. Literally, it broke 100 on the Dow.
Thank you for holding. We apologize for the continued delay. We'll have a colleague with you shortly. Please note, calls may be recorded for training and security purposes.
Yeah, well, I'm glad you kept with it because other people might.
Yeah, but I mean, all the other kids in 7th grade had their money in something else.
Right. Getting back to banks for just 1 second.
Sure.
And the specific name, which is Wells.
Yeah.
And are you getting frustrated with Wells Fargo?
Well, I think they've been through a lot of problems, but I don't think that the fundamental franchise and all that, I mean, I'm fine with that. I forget whether it's in 1 out of every 3 households in the country. I mean,
Thank you for holding. We're experiencing a high number of calls and apologize for the delay in answering your call. You can find information or make a payment on our interactive website at www.oilbritish.gov.uk. Please hold the line and we'll have a colleague with you shortly. Please note, calls may be recorded for training and security purposes.
We live in a brochure. Something will happen. You can't run away from 395,000 people and not know this. All this is happening all the time, and these are all tested and nasty.
Hi there. I just need to talk to you about that.
Everybody's out. But yeah, Salesforce makes mistakes sometimes. And bad practices will spread if not jumped on. And that's what you saw it. Well, they didn't. I don't see how the world would made anybody out of phony accounts. But the cost again, there's a ripple effect. I mean, when something goes wrong at Berkshire, if it doesn't get corrected, there'll be more problems subsequently. Dr. Solomon, Charlie, gave me the formula. He said, you know, get it right, get it fast, get it out, get it over. And anytime you see a problem and you're a responsible party in corporate America, that means you get it right, get it fast, get it out, get it over. And don't skip and just put that right in front of you and go to work on it.
Yeah, maybe I don't know about the get it over part.
Well, if you get it right and get it fast and get it out, you will get it over.
Okay,
and if you don't the other things you've got, you'll never get to get it over.
Okay. Fair enough. Let's switch over and talk about oil. You are an investor in the sector through this Occidental Petroleum deal for last year, $10 billion, I think, and maybe some more after that. I know you get preferred dividends, but that investment has to be underwater at this point. And what's your thinking?
Well, the 10 billion is the first stock that warrants it. But and there is no margin.
I don't think so.
But
I think did before Katomo, so.
And you know, as I said when I did it, I mean, the biggest variable is the price of oil, and I don't know the price of oil, and every day it gets quoted. If you have an opinion on oil, you can buy or sell oil either 1 year out, or 2 years out, or 3 years out, or something of the sort. And when oil was in the 30s,
What's the problem?
there's a lot of agony in the oil patch, and the math just changes terrifically. It just doesn't pay to drill in a lot of areas. And the Saudis can turn out a lot of it with practically no operating costs or,
No problem.
operations.
I mean, between that war between the Saudis and the Russians, and then also perhaps the secular decline of demand,
Okay.
given concerns about climate change, is this really a great place to invest?
Well, I don't
Okay.
think the secular demand will change that much. It's certainly the immediate demand change.
Okay.
People drive less.
Okay.
Working out of their homes. I mean, it changed. You're talking about something close to 200 million barrels a day. You change it by 5%. That is huge.
I was reading in your
No, I just make it as a when, so as soon as I get paid, I'll make it.
which is so big in wind power and has
but
this
yeah,
very
that's-
different business model.
So the next one will
that
be
alternatives
24th
actually have a
of
real
this
future?
of this month. Yeah.
They are the future. But you can't change the world. The base of the world.
Okay. Oh, that's fine. So has it been taken off now?
Whatever number it is in the United States, how many around the world. And they're not changing what they use tomorrow.
Okay.
The average age of
So the summons have been taken off now.
the auto, I think, is
Oh.
12 years. So the world can't change.
Yeah. Thanks very much. Thank you. Take care. Bye bye.
10% a year. It just doesn't work that way. But the world is going in the right direction in terms of working toward minimalization of carbon.
Go see all kinds
Cars,
of.
I mean, look at Tesla and what Elon Musk is doing. I mean, that kind of is a
It's
revolution.
just called someone's going really shit.
Well,
Someone's
it's
okay.
an important change, but if you guessed on the penetration of electric cars, let's say we say 17 million or something a year in 2030 when I'll be 100, I would say that I'd be surprised if more than a third of those would be electric. Well, that's 2/3 that aren't, plus all the ones in. So, of the total vehicles on the road, it still might be 10% to electric tops or something like that worldwide. I mean, you can't change this mass of transportation. You can't change it in a year or two. It is changing and should change, but in terms of just the math of replacing, if we said we're going to junk all the cars we have, well, the economy would stop. I mean, we can't produce them. We couldn't replace them.
What do you think of Elon Musk, though? If you met him, and would you invest in Tesla?
Well, I think you're trying to bait me.
I don't know. I'm just asking you. You can say no, and no, or yes,
listen,
yes,
he's
and
done
yes.
some remarkable things. He's done some remarkable things.
Have you met him?
Oh yeah, he joined the Giving Pledge some years ago. I've only met him once or twice, but yeah, I've talked with him for quite a while.
And would you invest in Tesla?
No.
Okay. Let's switch over and talk about bond yields and interest rates, because that's a crazy subject right now.
It is a crazy subject.
And
it is really crazy.
Yeah, so what is your thinking on it?
I don't know. I've never been able to predict interest rates. I've never tried. I don't. Charlie and I, we believe in trying to function on or focus on what's knowable and important. Now, interest rates are important, but we don't think they're knowable. And there are some things that are, this gets back to, something, who was it, Don Rumsfeld or something?
Known knowns and unknown
yeah, and all
unknowns
that.
and unknown
And
unknowns.
the question is the box that says knowns and important, knowable and important, is there anything in that box? And can you tell what's in that box and what isn't in that box? And it's what I call knowing your circle of competence. And my circle of competence doesn't include the ability to predict interest rates a day from now, or a year from now, or 5 years from now. So I say, can I function without knowing that? It's the same way as predicting what business is going to do or the stock market is going to do. I can't do any of those things. But that doesn't mean that I can't do well investing over time.
I mean, but things have changed. They're different now because rates are so low. You
It's
have negative
unbelievable.
rates.
It's unbelievable.
And then you were talking about Edgar Lawrence Smith
Yeah.
and his discovery about bonds versus retained earnings. And then I think you were saying that it makes, as far as central banks, it makes no sense to lend at 1.4% and then to have 2% inflation.
Well, it doesn't make sense for you to buy bonds
Yeah.
if somebody is telling you that they're going to try and destroy the unit in which the bond promise is included. They're going to try to destroy 2% of that a year,
Right.
and for you to now receive maybe 0.5% and pay taxes on it.
Right. I mean, so where do you think these low super rates are going to go and negative rates? I mean, just what are the implications on
I would say that's the most important question
Right.
in the world, and I don't know the answer. No, if we knew the answer, it wouldn't be the most important question.
Ooh, I like that.
Yeah.
I mean, I don't like that, but
No, but it's
Right,
true.
Yeah. Well, so let me ask this way then: what has investing in equities changed given the interest rate environment? It makes equities look super cheap.
Yeah, no, it reduces the hurdle rate.
Right.
That's why they like to increase it. It pushes asset values higher because obviously, if you promised to pay something at 3% a year, that would have been a terrible instrument for me to own, almost any time in history. But today, if you're good for it, it's fabulous.
Right. I mean, did negative rates scare you?
They puzzle me, but they don't scare me.
I want to switch over to Apple, one of your
I think
biggest
the twins,
holdings.
he gave back to them.
Does the amount of shareholder interest in this company concern you or Todd or Ted? In other words, the market capitalization basically relative to the S&P 500.
Okay, maybe.
Is that something you look at?
Well, you look at everything and relate one to another. I mean, that's the nature of the market. So you're always trying to think about, A, what's in my circle of competence, and then what makes the most sense that's within that circle. The important thing is know where the perimeter of the circle is. I mean, that's way more important than how big the circle is and a whole bunch of other factors. So I think Apple is within my circle of competence. I think it's an incredible business run by it. I've always one of the great managers of all time. He was underrated for a while, but now he's been seen for what he really is. It's in a sound. You could almost, if we had a card table here, well, yeah, we could put all their products on one table. Can you imagine that? I mean, and just think of basically the utility of those products to an ecosystem that is demographically terrific and finds that instrument useful dozens and dozens of times a day. It's almost indispensable. Not only the individual business, I mean everything.
And you have one of these babies, right?
I've got one of them. I don't have an option.
Okay.
I'd be afraid of it, and I wouldn't know what to do with it.
It's okay. You can take the call during this. There wouldn't be a problem with it. And what sort of apps do you have? Do you have any apps loaded?
Well, they've got a lot of apps on it, but
Warren Buffett needs little introduction. He's the godfather of modern-day investing. For nearly 50 years, Buffett has run Berkshire Hathaway, which owns over 60 companies like Geico and Dairy Queen, plus minority stakes in Apple, Coca-Cola, and many others. His $82.5 billion fortune makes him the third richest person in the world, and he's vowed to give nearly all of it away. The Oracle of Omaha is here to talk about what shaped his investment strategy and how to master today's market. I'm Andy Serwer. Welcome to a special edition of Influencers from Omaha, Nebraska. It's my pleasure to welcome Berkshire Hathaway CEO Warren Buffett. Warren, welcome.
thanks for coming.
So let's start off and talk about the economy
Hello.
a bit. And obviously, we've been on a good long run.
A very long.
And does that surprise you? And what would be the signs that you would look for to see that things were winding down?
Well, I look at a lot of figures just in connection with our businesses. I like to get numbers, so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy's going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses. And it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses. What those numbers tell me, they're interesting, but they're not guides to me. If we buy business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year, some year. And we care a lot about the price. We do not care about the next 12 months.
But are you surprised at how long this economy has been expanding?
I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, go back and read Keynes, read Samuelson, read any of them. They do not get into a negative rate. I think now there's still $1 trillion of government debt around the world that's sort of negative. So we've never seen it before, and we've never seen, at least the conventional wisdom of it, a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about individual businesses will do over time, and we compare that to what we have to pay for. We have never said yes to something because we thought the economy was going to do well in the next year or 2 years. We never said no to anything because we were right in the middle of a panic even at the right time.
All right, so you don't pay much attention to the business scientists then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But I just don't know of any economist that actually has bought businesses successfully or done well in stock. Paul Samuelson, may know he was a big shareholder of Berkshire. But it's, they make guesses, and there's so many variables. I mean, in the hard sciences, you know that if an apple falls from the tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables. But when you get into economics, there's so many variables, and the truth is, you've got to expect good times and bad times in business. And if you if you were to buy an auto dealership, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to make sure you got a good business. But you wouldn't set out to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
Fair enough. You have over $100 billion of cash.
Berkshire does.
Berkshire. No, you've won. We have seen how much stuff. Maybe you do. Berkshire has over $100 billion in cash, and you say that you always want this company to be a fortress. So how much cash should an ordinary investor have on a percentage basis?
It depends on their personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of decent diversified businesses, you really need any cash.
So you can be more cash-free than Berkshire is.
Yeah, I've got responsibility. We've got insurance claims. We could have hurricanes that, would happen. All kinds of things where you might have to pay out billions of dollars, and you've got over 1 million people that own shares of the company run the place so we get through periods like that. But if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children owned the house was paid off and everything. I wouldn't worry too much about having a lot of capital.
Let's talk a little bit about Apple. Everyone always wants to talk about it. It's kind of the it stock, it company. You have a $45 billion stake, more or less. How closely do you follow the company? People are concerned they haven't really introduced any new products.
Well, if you have to closely follow, you should know.
Really?
No, I mean, if you buy a business, you buy a farm. You go up and look, every couple of weeks to see how far the corn is up, and you worry so much about whether it's going to be a year of low prices because exports are being affected, and you buy a farm. You hold it to one farm, but I've been there once. It doesn't grow faster if I go and stare at it. I can't cheer for it. More effort, or something like that. And I know there's going to be some years when prices are going to be good, and some when prices aren't going to be good. I know there's years when deals will be better than others. What about the farm? It just doesn't. I don't care about economic predictions on everything. I do care that over the years it's well tended to in terms of rotating crops. I hope yields get better, which we generally have. In fact, that farm years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre. Now in a good year, it would be 200. We really make progress in this country. That's one reason commodity prices go back a couple hundred years. They've moved so little. They've just gotten better and better. Whether it's cotton, whether it's corn, soybeans, all kinds of things. And you and I have benefited from that.
And so Apple is kind of like a farm.
Well, it's a long-term investment. And if you own the best auto dealership in town, the best brand, and it's a big running it, you would drop by every day and say, how many people have come up today, or I think interest rates are going up a little, maybe slow down in sales or whatever. You buy it knowing there's 365 days a year, and you can own it for 20 years, so that's 7,300 days. Things are going to be different from day to day and year to year. You shouldn't buy it up to day to day.
Let's switch over to talk about buybacks, which is another hot topic these days. And you did a fair amount. If you look in the annual report, you can see that between December 13th and 24th, it looks like you guys bought back $233 million worth of Berkshire, which was right near that particular stock market bottom. How did you know that?
Well,
what was going through your mind?
If I knew it, I'd have bought a lot more than 200. That's not a big purchase for us, actually. And we will I, Berkshire, only have lots of excess cash. All these little businesses are taking care of. We spent $14 billion on property, plant, and equipment. We take care of this. We have excess cash. And if we find investment, which others will find other businesses, our stock, if I think the stock,
See, you need a nomenclature. The troll hunters.
So it wasn't.
Cannot refuse the call.
Well,
What better call for you to
we
trade
thought so,
than a
yeah.
bite-sized
Yeah, well,
soiree?
but, you know, what's really intriguing is that you want to go down a lot. I mean, when you're buying dollar bills for 60 or 70 cents,
He's trying to
it's
distract
periodic. Cash, you know, so
At least I
there's
didn't take my newbie nubby.
some surprise that didn't take you out.
over here.
Rather than just
Yeah. But it's, you know, when I own a McDonald's, then they get $1 million, 50% of the company sales are up for $400. So you're but if you want 600,000, all of a sudden, come back to buy.
So, just continuing about buybacks, Senator Schumer's senators government to weigh in to sort of legislate when companies can do buybacks. And then also there was a report recently about executives doing insider trading, it appears, around the times of buybacks. So are buybacks a kind of problem?
Well, you'll have some people that misbehave in respect to anything. So I think buybacks, the degree to which they've been part of nefarious activity, I've observed for a lot of years.
Master Jim, press
Very
on.
close to
He's not gonna cut you off.
Well, what else can I do? I can't fit in that hole.
No troll hunter has ever
that
lost his
article
ammo.
did not.
Many times you procure the Fergally.
I didn't follow the conclusion. Distributing money to shareholders, essentially, through my dividends, and presumably the American business occasionally. And we do it for buybacks. We've got some. We don't do it through dividends. But most companies do it through having a dividend policy. And then if they have money beyond the needs of the business, if their stock is underpriced, then it makes nothing but sense.
So the government tell companies when to mandate conditions where they can.
Well, they do restrict you a little in terms of if you're.
What kind of heart did Maria have, Miss Wang?
Sometimes it's isn't quite the right word, but manipulative activity or anything like that. But
I
not,
would hope Maria wouldn't have,
I don't
but
think
also
it's
hot,
decided.
because that would be ghastly.
I don't even think it's directly capital investments. They can make it enticing to make
You were trying to say Casado
renewable
heavy
energy.
heart. And it is
The
a heavy
government
heart, Miss Wang,
has
to tell you.
interest in
But that shows the slightest comprehension of the basic Spanish.
And
If you
they
can't
do
use the exam,
feel
I have no
like
choice
oil
but
to
to
fail.
fail.
50 years ago. That was more politics than it was governmental policy, but certainly renewable. Prime example of that. But the idea of directing
Hey, Carter. Hey,
title
you know, I got this Spanish exam coming up. Muy importante. And I was looking for someone to help me out. Maybe
I was looking for my same partner
The
last night.
2020 election is going to be
oh man, the play.
and
I don't know what you've got
nice
going
things to
on,
say
but
about
this
Mike
place is pretty important to
Bloomberg,
me.
but it appears
My
he's not
family's
going to
coming,
be running
and if you make me look like an idiot up there,
Claire, I'm sorry. I promise I won't miss
I
a
hear
thing.
about a few others. That's funny.
But I admire
By the way,
democracy. I wish you
I
had
don't see this stuff, but there are better ways to finish the fight than pushing someone in the face.
So two questions. Is the business executive the right kind of person to be president? And what characteristics do you look for a president that you would support?
Well, I think a business executive can be the right person, but I don't think that because they're a business executive, he would affect performance. Number one, I want a president who thinks I'm going to be president and realizes that the greatest threat to a country which has got all kinds of things going for it, weapons of mass destruction, and that we live in a world where people, organizations, and occasionally countries could going to have people that wipe out a large percentage of the American
We build it here,
or maybe
right under their noses.
and
Are
they
you a
now
fool?
have capabilities.
Haven't you ever heard that the
I
best
would
hiding
call
place
police
is in plain sight?
Don't be
I
nice.
that cyber
Impure.
that some people
Waiting.
crazy
It's
reasons
taking time for the changelings to acquire the
happen
remaining
with
pieces.
Yeah, somebody that thinks that it'd be great to
The age of
send a false
gunpowder
alarm
is at hand.
so that the Russians, that the other side was launching or something of the sort.
Remember what I told you,
very,
all
very
troll hunters must start
dangerous.
small.
It's a wonderful war. It has danger now. It started in August.
Full disclosure, I'm a little worried how I let you talk me into this.
Everything in the world. So I want a president that has that same ability. All of the others are important, but protecting the country and reducing the chance
Wait a
of
minute,
success.
so how does me going into this thing help me get a gnome out of a hole?
If anyone want out,
One job.
the troll hunter
Most
must
of the
go in.
presidents. I've told you what?
Don't worry, we all believe the Ferguson to compress
I mean,
minerals.
they do realize that they get lost in the events.
Hey! Are you done with the few
Beyond
times
that,
on Flesh and
I
Bone,
want a
right?
president that
Right?
Not exactly.
has two objectives for the
But I'm not concerned.
Well, that's because you are not the one drafting this thing.
Nothing to worry about, Master Jim. We will advance under pressure.
I can't see anything. Why is there so much smoke?
They'll tell me what I want to hear. So I want to hear what they tell people who disagree with
On the
me.
contrary,
I always like to ask the candidate.
the Ferguson function perfect.
That's somewhere. I said, what are you for that the majority of your followers are against? You know, I know you really believe in that.
Real subtle.
That's reading the text.
We gotta start small, deal with the little problems.
Except
This
under-
is a huge problem. I can be shrunk. I have a chance today. I have victory.
It's, I really want to get, and that's why Bernie Sanders is so successful. 80% of people voted for Bernie Sanders, the politician. But they felt that they knew exactly what he would do. I mean, they felt he was authentic. And if you asked him,
One last thing to know when you know
he would tell you.
A few questions about Kraft Heinz.
Of course. It's right
Was that
there.
a
Brief
mistake?
recapitulation.
Find out over time, but we
Of
did
course
pay
not. Nothing in this world makes
We
sense.
didn't pay too much. So when we started out, it was originally a non-public partnership between us. And we did pay too much, in my view, for Kraft. And there's not much you can do about things if you pay too much. Secondly, there's always been a struggle with retailer and brands. If I've got a terribly big brand and I want to get into Walmart, I'm not going to do it. All kinds of crazy concessions and all that. And I want to be in that.
I forgot to get that amulet back.
The negotiation is way different. You got some concessions. 10 years ago, Costco.
Okay, I like me nummies too.
Category to category. They know brands, but in the end, it's a tough pull back in. Because the Royal Crown pulled back in. So there's always that struggle.
Oh my God, this is that.
There always will be. But retailers
Touches that.
First Walmart, and then
Walmart's got it. But it's been accentuated. We have a new retailing environment now. I mean, day, but it's huge sum. Billions of dollars developing, sponsoring TV shows, or sponsoring radio shows, and Campbell Soup was always on there with Jack Benny or something, when I was a kid, and it was big. And it built brands, and people obviously like the product too. But people are more willing to
Son of the armor and caught the gnome. Well played, Master Jim.
Thank you, thank you. I wouldn't get to little people.
Somewhat. It is not exactly very
What about this shrinking stuff? When does it wear off?
Don't worry, Master Jim. My boy knows his good news and how you have earned it, Jim the Gnome Slayer.
He was so young. There was so much music out there.
Sports. Who's your pal?
Now what is left
Watching
for you to take care of it.
Wait, what? Take care of it?
Rule number 2. Always finish the fight.
By finish.
And you still do to a great degree. But it's not exactly the same as it was 5 years ago or so.
I have to ask you, you haven't bought the stock, you're an admirer of Jeff
Oh,
Bezos.
who
The
are we
listing of the
kidding? I
richest
can't
people in
feel
America
this
came
thing.
out.
I nearly had dinner with it.
And Bill Gates is number 2,
Neither
you're
of
number
us are
3.
heroes.
So you can see what he's done in a myriad ways. And of course the question is, how come you haven't bought Amazon? Is there still time to buy? Would you still buy?
No, I always admired Jeff. I mean, I met him 20 years ago or so, and I thought he was something special, but I didn't realize you could go from books to what's happening there. I mean, he had a vision and executed it in an incredible way, something that it would not have, but there's a lot of games I miss. I would have missed Microsoft even if I got earlier. Those just aren't my games. I don't worry about the things that I miss that are outside my circle of competence of evaluating. I have missed things within my circle. And that's a terrible mistake. Those are my biggest mistakes. You haven't seen them. But I don't, it's not a mistake because I miss Netscape or something like that at all. I would say that maybe 5% of the companies or 10% of the companies at most are within an area of logical competence. There's something I should be able to understand.
All right, well, let me switch gears then and ask you about leverage. Corporate debt, people are concerned about. People are concerned about federal
I have missed things within my circle. Those are my biggest mistakes. You haven't seen them. But I don't, it's not a mistake because I miss Netscape or something like that at all. I would say that maybe 5% of the companies or 10% of the companies at most are.
Senator,